I'm Tira Gray, Managing Director of CoinDesk Events, and it's truly a pleasure to welcome you in our very first session, which could not be more appropriate to start the day with, from Wall Street to crypto. We have three esteemed Wall Street veterans joining us today for this opening session. It is my pleasure to welcome them to the stage. Good morning, gentlemen. You can hear me okay?
Yes.
We're off and running with our jet lag, and we're going to try to take this down as articulately as we can under the sleep-deprived circumstances. So you all had a tremendous career on traditional Wall Street before pivoting into crypto, and I thought it would be really fun for the audience to kind of hear what was your aha moment. So Mike, let's start with you. Lifelong career on global market infrastructure. It makes sense that the market structure potential of crypto would be an obvious opportunity. What was your moment? Where did you see this future?
Yeah, it came over time. I think it's fair to say I saw fragmentation for my entire life. And when you start scaling a proposition in financial markets, you naturally hit boundaries on how you can bring a product, an idea, to the next region, to the next market, and how to embrace the next group of clients. And my pivotal moment was when I really understood the impact of technology on where the planet is going in terms of computational power, connectivity, and realizing how much, and I may say that as a liquidity provider, how important liquidity is in driving sentiment into the right direction and driving adoption. So it came over a few years that I realized, okay, there is a big opportunity, equally / challenge, to get this right and to really gain a global perspective on how financial markets could look like in the future.
Terrific. Fabio, I'm going to go to you next. You ran founded Abraxas. 16 years in, you had a moment thinking, wait, we need to pivot to digital assets. How did this happen?
Right, yeah. Thank you for the question, because you know already the answer. For me, instead of overtime, it was just one day. One day I was on a plane from Milan to London, and I had an EasyJet magazine in front of me. And apologies for what I'm saying, but there was a beautiful picture of a very nice girl, actually, and I was looking at the picture, and then I saw Ethereum Foundation. So I started to read the article, and on that basis, actually, I got involved in finance, in crypto. That was my moment. Then, as soon as I landed, that afternoon, I met a guy that was doing arbitrage on sterling euro between two exchanges, and I was flabbergasted by the spread. I used to be working with less than a basis point spread on the swap market, and the guy was talking about percentage points. And that was back in 2017, early 2017. And then, in the evening, I was out for dinner with somebody else who was involved again in crypto. And in the night, I couldn't sleep. So the morning after, I started to study the crypto market. So that was my moment.
Serendipity, sounds like.
Yes, correct.
Gautam, you covered fintech investing your whole career, so I would certainly think that experience lent itself to this, but could you define what was the moment that it all clicked for you?
Yeah, sure. So I come from Web 2 tech investing background prior to getting into crypto. For me, it happened in two stages. Stage one was one of my very close friends wanted to start a company where you're trying to match resume to people's profile on LinkedIn, but couldn't do it and failed because couldn't access the database of LinkedIn. It was restricted. So when he got into Ethereum, he introduced that concept to me, and I found it very powerful that you can have like open databases to access, and then people can build on each other's work. So that was fascinating. And I think stage two was generally, if you look at most of the Web 2 companies, a lot of value accrues based on network effects, so whether it's Facebook, Google, and others. And when I learned about the process of how you transfer ownership to users, and then on the back of it, you build a network. So the power of network effects, I could see it play out in this new tech stack. So that was another kind of aha moment for me. When I combined those two, it was very clear to me that we need to take technology from just putting lipstick fintech versus really reinventing the tech stack for financial services.
And making it, I think, ultimately, we're not there yet, more accessible for all users.
Exactly.
And not this esoteric asset class. So let's go backwards now. I'll start with you again, Gautam. I would love to know let's start with the positive. What are the frictions in today's market that we are unanimously agreeing that crypto does solve for? And then we're going to obviously go to the other side of that. Where is it not succeeded yet? But let's start with the positive.
So I run Brevenhammer Digital, which is a crypto asset management management platform. This is a 24/7 asset class. You need to be able to move assets from dollars into crypto and out of that, literally weekends, weekdays, all the time. I think that is a new concept, if you will, for traditional finance. In fact, sometimes we run across this problem where we still have to interact with traditional finance institutions, and sometimes we have trouble on weekends to move from traditional rails to crypto rails, right? So I think that's kind of a big shift that's happened with crypto, where it's 24/7 and accessible to anyone at any point in time.
Fabio, I'm going to go to you.
I do agree. The big shift is really like this idea that it never stops. So it's trading all the time. It is fascinating from a certain point of view. It's challenging as well. As he was saying, is this when you have a mismatch, especially if you are involved, like we are involved as well at Abraxa and Ekasika, between moving assets from traditional, so the banking system, into the crypto and out all the time, because our strategy is based on arbitrage. And sometimes it's quite challenging. It's quite challenging, so you have to be creative as well and to find ways on accommodating this big difference. But it's fascinating. When you get involved, you cannot get enough, I have to say.
And Mike?
Yeah, so moving assets and moving liquidity is music to my market-making ears. So our mission really is in making that a reality. And I think what's increasingly clear to us is that the asset pool will significantly increase over the next 5-10 years. So then we come back to what are the use cases in DeFi and digital assets that really attract and accelerate institutional adoption, and then down the road also retail adoption. And I feel one key element for us as a market maker and liquidity provider is getting this right technologically. And this hopefully creates not just resilience, but also trust and confidence. And this is then, in my mind, the key to the door, which you need to make wide open to really bring regulators in, big institutional players that trust the system and also understand the benefits of what we claim will be the future coexistence between TradFi and digital assets and DeFi. And we are not there yet, yeah, and we are also not there yet as we are basically embracing a bunch of use cases where question mark could be put on how does that work out from a synergy perspective, and how do we want to bring that to the next level. I feel this is also about transparency and alignment. And then next to that, I talked about the technological side. If you just embrace the idea that computational power will increase significantly over the next 5 to 10 years, then you're a bit back in a big data game, because with digitization, the planet will earn and get more data, and that feeds then back into risk allocation models. And if you believe in it, I think the road into driving better decisions should be there. And what I learned from the TradFi side is if that is true, then you will have a significant impulse in terms of volume increases. So I'm dreaming a bit about getting this technological layer right, creating interoperability and connectivity, and then go from there.
It's amazing to hear big data starting to come back again. I thought that was dead about 7 years ago, and here we are back to big data. We've recreated it in a different shape. We've also recreated how risk and return works in this space. And I think this is a really important thing for retail investors to understand, and anyone who's looking at this space. We can't use traditional risk return models, I don't think, and I'm going to let you guys tell us if that's the case. But I would like to know specifically, what should we be maintaining from traditional finance and how we look at risk and return? And then where should we be shifting to a new lens? What part of the market? So let's go backwards. Mike, I'll go back to you.
Yeah, so I'm a big supporter of getting risk right. And when I just see how we build our crypto and digital assets business at Flow Traders, we very much focused on building an end-to-end control layer. And what we realized is this is not by taking what you build from an infrastructure perspective on the TradFi side and just tweaking it a bit. So you just need to go back to a 24/7 mindset. How do you operate markets around the world non-stop, and how do you treat risk internally? And this is not just about risk allocation, it's really about market risk and counterparty risk and credit risk. So if you put that all together, you just need a very high-functioning machine in order to get that right. But once it's there, right, you embrace really the benefits of digital assets adoption. And that's a bit the way where I hope the planet will go.
Fabio.
Yeah, I agree, and I would add, like, for us, when we do arbitrage, the counterparty risk is the most important one. you have to think that whatever is very traditional finance, you can apply obviously on the crypto eco space. But because the crypto eco space is still an unregulated, bunch of operators and players around, actually, I mean, the people here are probably all regulated, actually, but the one on the other side are not. So, counterparty risk, credit risk is very, very important. At the same time, like in our business specifically, we really use stress test because there are some idiosyncrasy actually, cities of a crypto ecosystem like that it does not really operate exactly as a traditional finance. Like the tweak he was talking about, I just make an example, is like perpetual futures initial margin. I mean, initial margin in traditional finance, you don't lose them when you get stopped. In crypto market, you lose the variation and the one. So if you're involved in basis trading, this kind of activity is very, very important to simulate stress testing scenario, having all the possibilities in front of you, and that is a bit challenging. But yeah, it can be done. I mean, if you done it properly, it's quite rewarding, I would say.
And Gautam, how do you have to say to that?
Look, we see risk management as not very dissimilar from traditional finance in the sense that if you think of the various forms of risk, right? There's market risk, there's credit risk, there's counterparty risk, there's technology risk. All these risks exist in crypto as well. It's just the extent is quite different versus traditional finance. So in traditional finance, you don't think about counterparty risk as much, right? So you're trading with the likes of Goldman Sachs and Morgan Stanley. Here, you're literally pre-funding exchanges. You have to think about exchanges, the risk that associate with like putting assets on exchanges. So that's kind of one risk. The second risk, which is different, is really the technology risk, right? Smart contract risk. So if you're providing liquidity to liquidity pools, you have to think about those risks. So that's different. Having said that, there are a lot of principles that we still use from traditional finance, especially as it relates to market risk. So one of the things we focus a lot on structuring trades with a risk-reward framework that's attractive, and the concepts are very similar, right? So you will look for option structures, and to be honest, option markets is pretty deep now across Bitcoin and ETH especially, right? So use some of those concepts there. In addition to that, you also look at risk reward, even when you invest in early stage projects or so-called venture projects, but they tend to be liquid. So in a way, those are almost like options where you effectively invest at a lower valuation and expect multiples return, but you can potentially lose half of that. So some of those market risk principles are still applicable even in crypto.
Do you feel like that we're creating, I mean, obviously I know we're all talking about how this solves everything, and it certainly hits on a lot of traditional pain points that we had on Wall Street for many, many years. But it does feel like at times we're creating a new ecosystem that's going to come with a whole new vulnerability, and it's not covered enough, particularly I'm thinking for the end user here and the retail investor. To be fair and honest here, like where is the new risk that if you were advising someone new to look at the space who's investing in it, what is the new risk that we are creating? And it might be solved in the near future, but what is it right now?
Look, the biggest shift, if you will, is the fact that crypto and digital assets is all about no intermediary, right? That's kind of the end goal, or let's say the ideal answer. Here in traditional finance, you are always dependent on an intermediary, whether it's a prime broker or a bank. So you can pinpoint any kind of issue and pass on the risk to that counterparty. Here, it's all algorithm, it's all technology. So some of those risks you have to manage yourself, and you can't really outsource some of that risk. So the capabilities that you need to build in-house is different from that perspective. So the role of technology in risk management, I would say, is far higher in crypto versus traditional finance.
Yeah, I agree entirely. On top of that, I mean, from a point of view of a retailer that actually get involved in it, sometimes it gets for granted actually that on the other side there is somebody that is a good actor, and here unfortunately sometimes is not actually. So the kind of knowledge you need to have properly, the checks that you need to make. I'm just thinking about DeFi specifically, like the smart contract risk, if it's been audited, not audited. These are concepts that normal people don't really know where we are talking about. So they actually log in, they think is safe, and they trade without really thinking too much. Thinking that on the other side you have, I don't know, the same as the normal traditional finance, but it's not. It's not, because everybody can actually create a protocol, put it on a blockchain, they just create a smart contract, and and maybe you have a backdoor to take all the money out. So there is massive risk there, and we are still, eventually it's going to get better, because good actors obviously were going to be pushed out, and the good one were going to stay. They're going to get bigger. They're going to attract liquidity. People like Mike will help them actually to get more liquidity, and eventually, like people will just trade on this, and they will just leave the other one apart.
I know, I think everyone thinks, oh, crypto is going to come in and it's trustless and permissionless and it's fixing everything for me and I don't need to learn anything. I can just start doing it. At the end of the day, you're still an investor. It's up to you to do your own research. There's always risk when you're making an investment into any asset class, let alone a brand new one. I want to read you guys a quote that I read last week. It's the CIO of a very large US pension fund. I was surprised by this. He said blatantly in an interview, quote, he did not see cryptocurrency as an institutionally investable asset class because it's low adoption among his peers and allocators. I would argue that's the wrong way to think about that, but I do think he is touching on something. Despite the enthusiasm, particularly the tailwinds that we're seeing right now post-US election, the institutional investors are not here. And to be fair, I want to make sure we're all on the same page with that term. Pension funds, endowments, foundations, sovereign wealth funds, they are not here yet. What is it going to take? When is this moment going to happen? What needs to evolve? And I'm going to start with you, Mike.
Yeah, I mean, the entire dynamic around how do you need to look into the global asset pool, how do you find yield? I think the bridge mentally into embracing digital assets is a very unique opportunity to increase the size of the global asset pool by trillions of US dollars. And then I come down to what you said on how do we create trust, credibility. So the way we look at it, providing end-to-end liquidity in a very reliable fashion, and also as a regulated house, very much in line with global regulation. I think that is the key thing to get right. But I also would like to just add, if you look into cryptocurrencies in isolation, this is not doing the trick in order to get it right. So, I mean, there are figures out there indicating that by 2030, the global tokenization a tokenized pool of real-world assets goes up to 30 trillion US dollars. I think this is quite a big number, but if you believe in that number, even just remotely, you will understand that we are building a full ecosystem that is end-to-end optimized. And I feel then you need to embrace the value creation chain more broadly. So you need to talk about the custody function, the settlement function, the relevance of data needs to come in, and then you basically start understanding that we are not talking about cryptocurrencies in isolation, but about digitizing the planet. And the fragmentation I mentioned at the beginning in traditional financial markets, maybe it's just, if I'm critical, fair to say we just got used to it and accepted it and built incumbent infrastructure to just relate to it. But the reality is that if you believe in real-time settlement and the availability of technological solutions to move liquidity in real time from one asset class to another across regions, I mean, this is just a significant step up in efficiency and effectiveness. And that should be the discussion.
Which are key terms for any conversation with an institutional investor. So it is peculiar that that has not resonated more firmly yet.
Yeah.
Fabio, what do you think it takes?
No, I agree with Mike. On top of it, I would say that, I don't know if it works the microphone.
Yeah.
I would say that I think, the gentleman was talking about not investable assets. I mean, you have to, they think at the moment, most of the institutions, they think like crypto is a gigantic casino where it's just trading. There is really no value under. Well, you can actually choose bitcoins, digital gold, this kind, and they stop there. But the reality of fact is exactly what he said. I mean, it's like behind there is like a gigantic revolution taking place, and there is value to be extracted investing in some specific project or whatever that will actually have abnormal return compared to the traditional assets where normally they are invested. But the issue here is like also. There is a gigantic issue that is like the people that are managing this big institution. I'm sorry to say they're old, and they don't really want to start learning, put their heads down. It's very difficult actually to study this stuff, to try to understand, because they're sitting there and they don't feel in a rush. The guy was talking about his peers. His peers are not doing anything. He's doing everything. Eventually, a new guy will come, will start investing. He will, they will lag behind, so will be forced actually to get into it. But to me, it's inevitable that eventually they will enter and they will actually live apart this idea that it's a gigantic casino where people trade in and out and whatever, and and there is value actually to be extracted.
Gautam, I would love to hear your perspective on this too.
No, I wouldn't blame the person who made that comment. To some extent, the signal-to-noise ratio in this asset class is not great, especially when it comes to how this industry is covered from outside in. And there are, it's a new technology, right? And there are fringe use cases. People used to say the same thing for internet back in 1990s and 2000s, right? So you had Amazon, which corrected 96% at one point. So I don't blame someone looking at it from outside in. Having said that, the way we think about it and the advice we give to our investors is that, look, this is an asset class where you should definitely dabble in. The reality is, over the last 17, 18 years, it's gone to $3+ trillion in market cap. So it's not nothing burger. So there is something going on there. But in order for you to really appreciate what's going on, you need to invest in this space a much smaller amount that you're willing to lose. But that gives you an opportunity to learn about this asset class much closer and much deeper. And then you will start to see the potential of it, right? There are applications that are getting built on this, which are generating revenue in hundreds of millions of dollars with much lower FTE count. The number of people involved to build an application is much lower than traditional Web 2 stack. So there's value to it, but it takes time for applications that we are all familiar with to actually come on these rails, and then you can use it. We're starting to see that with payments, stable coins, real-world asset tokenization. But I would say, I don't think media covers it in the right way from that perspective. That should change.
And this is a little controversial question, but do you think, are we far enough where FTX is in the rear view mirror for these institutional investors, that they've been able to reset what's been built since and the safety nets that have been put in since and the kind of cleansing that we had? Do you think are we past that yet, or are we still paying the price for it?
We have come a long way. We haven't completely passed that phase. As recent as last week, there have been some incidences already more in the DeFi side of things on the meme coin front. But I would say that the industry has come a long way. You have traditional players who have come into the space. Now, especially for us, most of our trading happens off-exchange settlement, where you actually keep your assets on custodians while you are able to trade on exchanges. So the technology has come far ahead in terms of the last 18 months since then. There's more work to be done.
Yes, there's always more work to be done. Okay, we are definitely light on time, so we're going to fly through these last couple questions before we get to our speed round. We have to cover centralized exchanges. Mike, give the audience your take. Where's the value of these? Where's the risk? How should people think of centralized exchanges in about 30 seconds?
Yeah, I was just about to add, so FTX for me is a call for action, not just for now, but also for the future. When we believe in driving innovation into use cases and transforming the entire infrastructure, if you will, and the way even institutional and retail investors will invest, then I feel we need to make sure that that innovation, A, becomes super transparent, so that investors have a clue what we are trying to improve, and transparency about the benefits. And benefits are, talked about settlement, but availability of data and moving liquidity without fragmentation around it. And as a market maker, I should be quite vocal about price discovery. So getting the best price and giving you a possibility to transact whenever you want to. I think that is a key ingredient. And the last point on data I want to make is, we feel data is perfect, but the reality from TradFi is the data world is not perfect. Yeah, even the data that is available is not perfect in order to feed risk-return models. If you believe in digitization, then there is a purifying effect on data quality, and that should massively impact the quality of investing. And it will trickle down from the institutional side into the retail world. Mm-hmm. So that's very much a belief I would like to carry forward.
Okay, I cannot believe... Oh, sorry, go ahead, Fabio.
Sorry, so are you pro-centralized exchange or not?
Well, I'm basically decentralized in a way that you need to basically fight fragmentation to make sure that you create interconnectivity and in a way also connectivity across all the different markets. And that is simply possible now with looking into technological advancement and making sure that you're connecting all the different markets. So,
okay.
Yeah.
Okay. Sorry, I didn't get it.
Okay. We're going to rapid fire speed round here. These truly have to be 1 or 2 word answers to keep the integrity of this speed round. So, what's the next Solana? Mike.
So I would like to
Two words.
So I'm quite excited about our stablecoin project, All Unity. I don't want to do any marketing, but I very much believe that Europe has a fair chance to embrace a stablecoin in order to accelerate digital adoption.
Aptos.
Wow. Good shout out.
Next Solana is Solana.
Say it again.
It's Solana.
Solana is the next Solana. Okay. I like that. All right. Bitcoin. Is it going to decouple from the rest of crypto? Yes or no?
I don't think so.
Yes.
It already has.
There we go. 3 perspectives. That's the point of this panel. Finish this sentence in 1 or 2 words. Meme coins are
A threat to long-term innovation and adoption.
Should be banned.
Good to battle test the crypto rails.
perfect. Ready? Public or private blockchain?
Public.
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 There we go on that one, unanimous. Okay, this is my favorite one. I left it best for last. When we used to all, I think we're all up here, remember using CDs to play music? And we thought, oh, this is it. Music will never get better than on a CD. We used to use a rotary phone to make a phone call, and we thought, this is all we need. We're sitting here today, 2025. Take yourselves 5 years into your future and your careers. What are we going to look back on in this year thinking, oh, that's what crypto used to do then. Those are the old ways of doing it. So what's going to be, that's new now, old in 5 years?
I very much bring it down to the end user experience of investing. I think we fully underestimate the impact on our lives with this.
Yeah, I like the idea of, the new way of investing, but at the same time, I will probably be on an island doing nothing, so I will not probably be here.
And Gautam.
Paying gas fees for everything we do.
There we go. Okay, past, present, future, Wall Street to crypto. Here we go. Thank you, everyone.
Thank you.